week of October 2025. And overall, all things considered, it was a reasonably quiet week. The Nasdaq and the S&P 500 down a couple of percent the end of last week, the Russell 2000 a little bit more, and that was off the back of more rhetoric from Donald Trump, which he kind of retracted during the weekend. First of all, saying that in response to China's rare earth restrictions, he would put 100% tariffs on China, later acknowledging during the weekend that probably wasn't sustainable, and intimating that he'd like to get along a little bit better in terms of trade with Xi Jinping if he were to come to the table. So there's a meeting coming up. All things seem to point to the fact that that will continue, and markets are certainly betting, prediction markets specifically and equity markets more generally, that this is going to blow over. But the big thing that's probably got the headlines and the focuses of a lot of investors is the price of gold, which has been on this inexorable march upwards, and we've started to see a little bit of volatility later. So a strong start to the week, up and down a few percent, and then down by 4 or 5% just overnight the last couple of days. And that's the biggest fall that we've seen 2020, and maybe going back to the GFC as well. And obviously this is a photo that one of our team took last week, and you can see the queues outside the bullion store in Martin Place in Sydney, and that's been a sort of constant thing over the last few weeks. So retail is very well and truly on this trade, and that's perhaps one of the things that's contributing to this unusual relationship. Slightly noisy chart, but if you focus on the fact that the turquoise line, which is the relative performance of gold versus world equity markets, has an inverse relationship with the performance of equity markets, because it's been seen as a bit of a crisis hedge, a bit of an alternative, all in the name there. But in actual fact, and if you just focus on that right-hand side, it's been moving very much in sync, and that's got a few people scratching their heads. And there's a bunch of charts that we can show that show the degree of ETF flows, retail participation, but perhaps this photo says it all. But behind that, and this is another very striking chart that's been doing the rounds recently, and it's the extent to which the Chinese central bank has been ramping up reserves. This has been replicated by other Asian central banks and perhaps other banks around the world. And it shows you that there is a mix of fundamentals and retail participation, but it's certainly become a market that's been more driven by liquidity, momentum and sentiment. And which brings us to our last chart on gold, which is, we get asked a lot at the moment, what are the fundamentals of gold? And it's always been a difficult thing to pin down. People have associated it with an inverse correlation with the real yield on bonds. If real yields are particularly low, then that should be good for gold, or is it a crisis hedge? And it seems to have a narrative for all seasons. This is one very long-term chart that we thought was interesting. And if you wanted to sort of maybe suggest that we are getting to some kind of a peak, this is hours of work to buy 1 ounce of gold. So if you can relate it, when you strip away everything else, currencies, equity markets, cost of living, etc., the one constant, how much how long does it take for someone to buy an ounce of gold? You've seen these peaks in the past going back several hundred years, and this is kind of up there. But on the other hand, would you bet against that trend of central banks de-dollarizing? There seems to be some long-term thematics around that. We don't know. So we keep trimming, and maybe a little bit in portfolios provides a little bit of diversification, although we should be aware that relative to equities, it's not looking very diversifying at the moment, and that little bit of volatility recently maybe underscores that. So sorry if that's a slightly unsatisfactory answer about what is driving the price of gold. There seems to be a lot of things. Does it have a place in portfolios? Yes, it has a little bit, but we're also trimming as well. The other thing which is probably worthy of note recently is in the last week, the US Treasury 10-year yield dipped below 4%. Australian yields have also been coming down in sympathy. They tend to track quite closely. So if you look at the right-hand side of that chart, it's been in that sort of 4 to 5% range, but generally on a downwards trajectory for the whole year so far. But we're getting down to the lows. And that's also got a few people perplexed. If you look at this chart here, which shows the US 10-year yield alongside equity markets, you can see there's that sort of traditional relationship, which was upended during that inflation scare that we had a few years ago. But we seem to be settling back into some kind of normality where yields were coming down when growth was under pressure, as you can see earlier in the year. But what we've seen recently is markets, especially the S&P 500, marching ahead steadily as yields have come down. And there does seem to be a little bit of sticky inflation, but if that was the case, along with a slowing US economy, you wouldn't expect equity markets to be quite so sanguine. So that's got a few people sort of scratching their heads and asking whether the bond market is sniffing out a recession. There's certainly signs of that in the credit market. So credit spreads have started to sort of tip up a little bit, especially in high yield. We've seen some of those bankruptcies in the US. And we were talking to a fixed income manager today who pays close attention to defaults and maybe some other signs in Europe of stress, particularly around that sort of consumer orientated auto loans sector. So bond markets telling one story, which is maybe pointing to a slowing US economy. And if we look at this time at cash rates in the US, you can see maybe another rate cut in the past few weeks being priced into markets, which sort of suggests that the Fed will have a reason to maybe think about cutting rates a little bit more, and that's been mirrored in Australia as well. Perhaps for different reasons. Recent jobs report actually showed a slight tick up, unexpected increase in unemployment, although on the other hand, that was because of increased participation. So a little bit of a mixed message there. But the bond market seemed to be thinking that maybe the economy could be looking at a little bit of softness. But overall, maybe a bit of noise. And talking of noise, that's not what we're getting from US data because of the government shutdown. In fact, it's been stunningly quiet on that front, and markets seem to be okay with that. Now, maybe one of the reasons is so far, even though only about 15 to 20% of companies in the US have reported, the results have actually been pretty strong, and the revisions have actually been on the upward side, as you'd expect. And coming into the reporting season, the revisions have actually been fairly resilient, which is pointing to a little bit of confidence. As you can see in this chart, certainly at the earnings level, which is the red one compared to the blue one for revenue, you're starting to potentially see a little bit of a broadening out, because it's not just tech, it's also utilities starting to report some of these strong earnings. As I said, it's only a handful of companies at the moment, but it is indicative. We've also seen the banks looking backwards, much higher cash flows, revenues up a bit, but earnings up a lot more, a lot of deal making going on. And you could say that three sectors out of about 8 or 9 there looking very strong, mid-teens to high double-digit growth. But on the other hand, when you look through that, a lot of it is related to AI capex. 14% we read of credit deals being done in the US are somehow related to data centers or energy. And then within utilities, that's obviously having an impact as well within the energy sector. So really, there is still this bifurcated economy, even though at a sector level it looks a little bit broader between the real economy. And if you look at the right-hand side of that chart, actually a lot more subdued. But looking forward over the next week or so, things might get a little bit more interesting, because that's when we'll see more of industrial US companies reporting. So far, it's been a bit of a mixed bag. John Deere, Caterpillar, stocks like that, Halliburton, talking about tariff impacts. But generally, the feeling seems to be that companies still have the wherewithal to absorb it in margins and operational efficiencies. But maybe when we see the next 300 or so companies report over the next few weeks, we might get a different picture. And then about 2 weeks from now, you'll see some of the big tech companies report, and then we might get an indication of whether some of this capex might be turning into profits and being monetized. Anyway, in the absence of data coming from the government, the corporate side is probably going to provide some interest in the next few weeks, and we'll probably comment on that next week. Talk then.